Hello viewers. Stephen here, and I welcome you to this channel where we talk about investing, business and finance. In today's video, we will be talking about 5 investing skills only millionaires know. But before we begin, be sure you have subscribed to this channel and smash that like button on this video to support the channel. Thanks for doing that. Now let's begin. Do you know what's the best financial tool humans have ever invented? Passive income. The ability to let your money work for you. And one of the best places to do that is the stock market. While there are a lot of good retail investors, there is a good number of beginners who try to predict future stock prices by looking at charts. If this is how the chart was moving, then this is what should happen. If it has been growing for the past few months, then it should keep growing for the next 3 months. Whatever the argument is, we have to understand that stocks are not lottery tickets to gamble with. Behind every single stock there is a company that manufactures something, builds something, or provides a certain service. So you don't have to look at the stock only, but rather look at what is the business behind that stock and how well it's performing. I know that sometimes it might get a bit difficult, because there could be so much news around some stocks that you don't even care about the business as long as the stock price seems like it's growing. That's why here in this video, I want to share with you how to take your investing skills to another level. I am not going to talk about the basics of investing because we have covered that in previous videos. I will assume that you already know what the stock market is, you have traded some stocks, and now you are looking to improve your investing skills. You want to be a little more professional. So here are the 5 things that if you understand and follow, you are going to become a far better investor. Number 1. Understand how the market moves. Timing the market is impossible, and whoever tried has failed miserably. That's why long-term investors have always emerged victories and made most of the money. However, the market doesn't just move up and down randomly. The stock market dates back to the beginning of the 17th century when in 1611, the Dutch East India Company decided to sell its stocks to the public, and since then, the market has developed enormously. So the market follows certain patterns and rules. If this is what the government does, that's how the market reacts. So if you understand these patterns, you might be able to predict the market to a certain extent. When the economy slows, consumers buy less, which means corporate profits fall, and stock prices decline. That's when investors prefer the regular interest payments guaranteed by bonds. That's why bond yields rise. Understanding the relationship between bonds and the stock market will help you to understand the direction that the market is headed to. But that's just one out of many factors that influences the market. Take, for example, fiscal policy. When the government regulates the spending and tax policies to influence the economy, especially macroeconomic conditions, such as aggregate demand, employment, inflation, and economic growth, which will end up influencing the stock market overall. Lowering taxes will make corporations more profitable, for example, since now they can keep a bigger chunk of their profits, therefore, their stock prices will rise. However, the government doesn't randomly raise or lower taxes but instead follows policies to keep the economy stable. There is also a monetary policy where the Fed controls the supply of money in the market by either adjusting interest rates or printing money. And each of these policies influences the market in different ways. So if you want to become a slightly more professional investor, understand these concepts. Find out to what extent they influence the market. You won't be looking at stocks as some numbers on the screen of your smartphone, but you will have a broader idea of how the market is actually performing and not what random YouTubers say on YouTube like myself. That's why they will always tell you that this is not financial advice, and everything that's said in this video is for educational purposes. Number 2. Learn how to read financial statements. I am really grateful that apps like Robinhood or Webull have democratized investing. Anyone can now invest in almost any company from the comfort of his couch as long as you have a smartphone, even if it is a $100 smartphone. No offense, but most of these retail investors don't look at a stock as a company but as a name that triggers the news, which makes their financial decisions quite irrational. Remember, the purpose of any company is to make money. That's the most important thing that matters. So if you want to know if a certain company is a good investment or not, you have to read its financial statements. If you are investing in a certain company without analyzing its financial statements, you are gambling. I know that I might get criticized for saying this, but that's the truth. A certain company might hit the headlines for developing a technology that will make us immortal, for example, but after looking at their financial statements, you may find that this company has a lot of debt, it doesn't have enough cash to survive till the end of the year, and its sources of cash flow are drying. The stock price might seem promising looking just at the chart, but looking beyond that chart, you start seeing the real value of that company. However, looking at the financial statement isn't enough if you want to take your investing skills to another level. Number 3. Learn how to do a fundamental analysis. When you go through financial statements, you will realize they have current assets, non-current assets, liabilities, long-term debt, short-term debt, equity. The company might not have any debt, which might look like a good sign, but it's not. If the company is not borrowing enough against its equity, then it might not be taking the best advantage out of its resources. Something might be wrong with this company. So we have metrics such as debt-to-equity ratio, where you divide a company's total liabilities by its equity. The ratio is used to evaluate a company's financial leverage. It is a measure of the degree to which a company is financing its operations through debt versus wholly owned funds. It illustrates businesses' ability to cover all outstanding debts in the event of a business downturn. Or we have something called the price-to-earnings ratio that measures the current stock price relative to its EPS or earnings per share. Once you master how to do your fundamental analysis, you will have a much deeper understanding of the company you are looking to invest in, and you will understand how well its performing compares to its competitors. Number 4. Define your strategy. If your strategy is to just get into the stock market, buy whatever is trending on the news, and expect to become a millionaire, then you can only rely on luck. Then good luck. And if you get lucky, you could be making millions of dollars, but luck is not a strategy. That's why don't invest randomly. Before you start throwing money into the market, understand what your strategy is. Are you trying to profit from the rise of highly volatile tech stocks? Or maybe you are more into passive income and betting in high dividend stocks. Or maybe you are more conservative and emotional, so you are more into mutual funds. Or maybe you do not want to wait that long to enjoy the fruits of your investments, so you get into day trading. It doesn't matter what your strategy is, as long as you have one. Number 5. Master a few industries. What distinguishes a great investor from an ignorant is how much the investor knows about the company he is investing in. As we have mentioned before, that behind every stock, there is a company, and behind every company, there is a product or service, and the success of that stock is going to be based on the success of that particular product or service. The people who early on invested in Amazon or Netflix, for example, had a really deep understanding of the internet. These people understood the internet so well that they could clearly see how 20 years later, everyone is going to buy his next gadget on the internet or would replace his cable subscription with online streaming such as Netflix. So to find a great opportunity in the market, you have to become an expert in a few industries. It doesn't matter what it is: energy, tech, financial services, whatever. Remember, to make a lot of money you don't have to be right every single time, you have to be right just once. $10,000 or $20,000 investment in Amazon back in the 2000s would have made you a multimillionaire. The same applies to almost everything else, including the cryptos. So if you want to start making great investments, become an expert in a few fields. Anyways, thanks, guys, for watching. This channel is possible because of you. You are the best audience in the world. We will always try our best to make the most interesting and useful videos possible. Thanks for watching, and I'll see you in the next one.